In 2023, Red Lobster made a decision that looked brilliant. Restaurants were packed, wait times were back. Social media was filled with videos of customers stacking plate after plate of shrimp, laughing as they ordered round after round. For the first time in years, it felt like momentum had returned. Customers who hadn't stepped inside a Red Lobster in a decade were suddenly coming back. It looked like a comeback story. But less than 12 months later, Red Lobster filed for bankruptcy. Over 90 locations closed, thousands of employees were impacted, and a restaurant chain that once generated billions of dollars in revenue was suddenly insolvent. So what happened? How does a company survive for more than 50 years, only to collapse after offering unlimited shrimp for $20? To answer that, you have to understand that this isn't just a story about shrimp. It's a story about leverage. It's a story about fixed costs. It's a story about thin margins. And it's a story about what happens when one bold promotion collides with years of structural pressure. Let's start at the beginning. Red Lobster was founded in 1968 in Lakeland, Florida. At the time, seafood wasn't considered everyday food for most Americans. It was coastal. It was expensive. It felt upscale. Red Lobster changed that. The company built its brand around accessibility. Lobster, shrimp, crab served in comfortable dining rooms in suburban America. By the 1980s and 1990s, Red Lobster wasn't just a chain, it was an institution. Cheddar Bay biscuits became iconic. Families celebrated birthdays there, high school graduations, anniversaries. For many Americans, Red Lobster was their first experience eating seafood in a restaurant. By the early 2000s, the company had grown to over 670 locations across North America and was generating more than $2 billion in annual revenue. On paper, it was a powerhouse, but the restaurant industry was changing. Fast casual chains began rising quickly. Chipotle, Panera, Shake Shack. These brands offered speed, customization, and lower price points. Younger consumers gravitated toward convenience and perceived freshness. Full-service dining traffic began to soften nationwide. Meanwhile, costs were rising. Labor costs increased steadily. Food prices became more volatile. Rent costs climbed in high-traffic areas. Margins across the casual dining industry tightened. Red Lobster wasn't collapsing yet, but it was no longer growing the way it once had. And then ownership changed. In 2014, Red Lobster was sold for $2.1 billion to Golden Gate Capital, a private equity firm. This is where the financial story becomes critical. Private equity firms often acquire companies using significant amounts of borrowed money. This is known as a leveraged buyout. Instead of purchasing a company entirely with cash, they use debt that the company itself will ultimately be responsible for repaying. Then Golden Gate executed a common strategy in private equity acquisitions: a sale-leaseback. Red Lobster's real estate, the physical buildings, were separated from the operating company. Those properties were sold, and Red Lobster now had to lease them back. In simple terms, the company no longer owned the buildings it operated in. It paid rent on properties it once controlled outright. This move generated immediate cash for investors, but it permanently increased operating expenses. Rent became a fixed cost, and fixed costs don't go away when traffic slows down. Then there was the debt. Interest payments layered on top of rent obligations. When revenue is strong, this structure can work, but when revenue softens, the structure becomes fragile. Margins shrink, flexibility disappears. Investment slows, renovations are postponed, menu innovation becomes harder to fund. The company still functions, but its margin for error becomes razor thin. In 2016, Golden Gate sold Red Lobster again, this time to Thai Union Group, one of the largest seafood suppliers in the world. The structural burdens remained. Then came 2020. COVID. Dining rooms closed, revenue collapsed across the industry. Red Lobster survived, but barely. When the economy reopened, a new wave of pressure hit. Inflation surged, food costs increased dramatically. Labor shortages drove wages higher, supply chains were unstable, and shrimp prices spiked globally due to disease outbreaks in shrimp farms and logistics disruptions. Now imagine running a business with High rent obligations, debt servicing requirements, rising labor costs, volatile food prices, and soft consumer traffic. That was the environment in 2023, and that's when Red Lobster made its boldest move: Ultimate Endless Shrimp. The promotion wasn't new. For years, Red Lobster had offered endless shrimp for a limited time, usually during slower seasons. It worked because it was temporary. Short bursts of traffic, controlled exposure. In June 2023, management made it permanent. Unlimited shrimp, every day, for $20. At first, it looked like genius. Traffic surged, restaurants filled, TikTok exploded with viral videos of customers eating dozens, sometimes over 100, shrimp in a single sitting. But here's where the math becomes dangerous. Shrimp is not cheap. Unlike pasta, bread, or rice, shrimp carries a meaningful cost per unit. Let's break it down simply. If the average plate cost the company, for example, $6 to $8 in shrimp alone, and customers ate multiple plates, the cost escalates quickly. The $20 price assumed customers would eat 2 servings, maybe 3. That's manageable, but customers didn't behave that way. They ate 5 servings, 6, 7. Some treated it like a competitive challenge. If Red Lobster lost $3 per endless shrimp customer and served hundreds of thousands of those customers monthly, that's millions in operating losses. If the loss per customer was closer to $5, the damage compounds even faster. By the third quarter of 2023, Red Lobster reported an $11 million operating loss directly attributed to the promotion. And here's the trap. They couldn't simply reverse it. It was marketed as permanent. Pulling it back risked backlash and brand damage. Keeping it meant bleeding cash. They were locked in. But here's the bigger question. Was unlimited shrimp truly the cause, or was it the final stress test? Even without the promotion, Red Lobster faced heavy rent from sale-leasebacks, debt from leveraged acquisitions, industry-wide traffic decline, inflationary food costs, labor shortages. Unlimited shrimp didn't create those problems, it accelerated them. In early 2024, the company raised the price from $20 to $22. It wasn't enough. In May 2024, Red Lobster filed for Chapter 11 bankruptcy protection. Over 90 locations closed immediately. Thousands of employees were impacted. The company owed over $1 billion to creditors. The shrimp didn't sink Red Lobster overnight. It exposed how little room for error the company had left. And Red Lobster is not alone. Across America, well-known brands have followed similar trajectories. Toys R Us, Bed Bath & Beyond, several casual dining chains, asset separation, debt layering, shrinking margins, desperate promotions to regain relevance. Sometimes collapse looks sudden, but often it's the result of years of structural pressure finally reaching a breaking point. Unlimited shrimp was supposed to reignite demand. Instead, it highlighted how fragile the financial foundation had become. Sometimes one promotion doesn't destroy a company. It simply reveals that the foundation was already cracked. The shrimp didn't create the weakness. It made it visible. And somewhere right now, another familiar brand is running a bold promotion, hoping the math works out differently.